Hello, everyone. It's Craig Larson with Larson Financial Advisors for the Market Minute on March 28th, 2020. I hope and pray that you are all safe and well during this challenging pandemic crisis that we're all going through. What I wanted to cover today is the big question for all investors, which is this market drop that we've seen a buying opportunity? Is it a buy the dip kind of situation? Or is it the first wave down of a longer term bear market and we haven't seen the bottom yet? In other words, would the rally that we saw last week be a selling opportunity to get out of stocks? Well, unfortunately, that's not 100% knowable. So all we can do is put on our detective hats, look at the evidence, and try to make a decision which will increase our probabilities of success with investing. One of the things that makes this difficult this time is that it's unprecedented. It's not unprecedented that we've had pandemic, we've had Spanish flu and swine flu and Hong Kong flu and Ebola and Zika and SARS, and there's been a number of those things. What makes this time different is that we have essentially shut down large percentages of the entire global economy to slow the spread and to let our medical resources have a chance to catch up. So unfortunately, we can't look at fundamentals and really get a good grasp on what should the decision process be, because we really haven't tried this before. So is there a possibility that once the virus runs its course in a couple of months that we get a V-shaped recovery? Yes, that's possible. Is it possible that because of the valuations and level of debt in the stock market that the virus is just the pin that pricked the bubble and we're now going to be in a long-term bear market? Yes, that's possible. So as investors, we need a strategy to be able to accommodate either outcome. One of the things technically then that we'll do to try to give us some hints is look at the asset class rankings. So if you'd followed the videos in the past at all, you know that I would look at a broad long-term asset class ranking, which is just basically a big arm wrestling competition between US stocks, international stocks, commodities, foreign currencies, money market, and bonds as a category, and that will tell us where the trend strength is. Now, prior to the decline in January, US stocks had the #1 rank versus all those asset classes, and it had stayed in that position for about 4 years as #1. So now, because of this first leg down in what potentially is a bear market, it's gone to 4th place out of 6th. So we've got money market or cash #1, bonds #2, foreign currencies, and then stocks, and then commodities and international stocks all the way at the bottom. So in the past, if we've had V-shaped recoveries, when we start to see these rallies take place, like what we saw last week, we would expect that stocks would start advancing back up the ranking and overtake cash in the ranking fairly quickly. That would be the big clue that it's a V-shaped or quick recovery back, and you want to stay in growth mode or get back to growth mode. Now, in the event that this leg down has put stocks in 4th place and the next leg up in the market, which obviously started last Tuesday, if the market's going up and the rankings are not going up, then that is more of an indication that we're probably in a bear market, and that was just the first leg down. So what I wanted to do is also take kind of a historical look at the 4 biggest bear markets of all time and what happened during those times. So the first one we would look at is the recent 2008. Okay, the first leg down of that was 20% down in the stock market, and then the next leg up retraced about half of the loss, and then the next leg down started. In the year 2000, the tech bubble, when that burst, the first leg down was 30%, and then there was about a 50% retracement back. It got halfway back up before the next downturn. 1973, first leg down was 20% down, and then guess what? Retraced about half back up before the next leg down. And finally, the granddaddy of them all, 1929, which was the peak before the Great Depression, that first wave down was 50% in stocks, and then it retraced about half before going down again. So let's look at what's happened over the last 6 weeks in the stock market. Is that we had about a 30 to 32% drop in S&P 500, and we haven't gotten that 50% retracement yet. We haven't gotten back half. Last week, because of unprecedented stimulus by the Federal Reserve and also the congressional bailout or stimulus package to Americans, we got about 38% of the way back. Now, those of you that are technical geeks like me would recognize that, hey, 38%, that's the first Fibonacci level. So for those of you that want to research more about markets, you can research Fibonacci retracement levels. We had just last week fulfilled kind of the first bounce back level. And so there could be a next leg down anytime. We could go all the way to 50% or 61%. And so we hope that this rally pertains a little longer. Now, in the next week or two, if we get more upside in stocks and the ranking does not change, in other words, stocks don't start gaining on money market, that's a very ominous sign. So what's the point of all this? Number one, investors should be taking this very seriously, okay? 10, 15, 20% drops in a portfolio, they can be fairly easily recovered in a reasonably short amount of time, okay? 40, 50, 60% drops in portfolios take years and years to recover from. So especially if your timeline towards horizon is not very long, you need to pay attention to this, okay? In 2008, the stock market went down 56%, and it actually got back to levels that we hadn't seen from 1996. So in other words, 12 years of process wiped out in about 18 months. So take this seriously. Those of you that are clients of mine, we've probably already had several discussions about this. And as you know, we have a strategy on how to accommodate that and protect and move defensively. Those of you that don't have a strategy, please get one. It's very important. So feel free to contact me personally, and I'd be glad to have a conversation about your portfolio. Those of you that would like a deeper look at some of these rankings and charts that I've been speaking of, I'd be glad to do a webinar or a Zoom meeting, and I can give you more details if that will help you come up with a plan that you're comfortable with. So please stay safe and healthy out there, and we'll all get through this, but make sure that you have a good investment and financial plan, and I will try to get back to you relatively soon with another video update. Have a great day.